Awesome, guys. So we are back live here on a Saturday evening. I don't typically do this, and this is not going to be a reoccurring theme. There was some technical difficulties last night, which actually allowed me to go on for about 25 minutes, unknowing that I wasn't online. I think we've got that technical piece of it fixed. I'm planning on getting to a lot of the topics that I wanted to talk about last night. And if you were in the group last night, and you're going to fight through another one this evening, I want to thank you guys for your devotion to the group and striking up a little bit of dialogue for a few minutes every weekend about personal finance, about budget, savings, and most specifically the stock market. And this is a piece of information that I was I'm kind of beating myself up a little bit for not actually providing this information earlier to you guys. But this actually is a little bit off topic in that it has to do with life insurance, whole life insurance directly. And if any of you guys out there have a life insurance policy, especially a whole life policy, I really want to get this out there. This will take about a couple minutes just to give you guys an idea of what I experienced in my life. And a lot of people that I'm coming across who actually carry a life insurance policy of a whole life variety. Okay. And unknowingly using that policy as an investment vehicle. All right. Make no mistake, my opinion about life insurance is that it is absolutely not a investment vehicle. Okay. It is a sound and responsible piece to any financial plan that's comprehensive in nature, taking into consideration if you had an event in your life where you couldn't take care of your dependents, for example, and it helps bridge the gap between an unexpected event to where you weren't around anymore and couldn't provide financial help. But specifically, with regard to the whole life policies, a lot of folks have those policies in place, and they've had them in place for years and years and years. And a couple things happen when you actually fund those two accounts, all right? The cost will go in there to fund the cost of the insurance, okay? Or basically pay for the premiums of the insurance over time, okay? What people don't really realize is that a portion of those proceeds every single month will roll into a cash account, all right? And it's actually a fairly high yielding cash account. A lot of them have baseline minimums of around 3% in those accounts, and they'll accelerate in growth. They've got a little bit of mini compounding going on within those cash accounts over the years, all right? They go unobstructed, all right? They grow over time, and a lot of people just forget about them like I did. I had my policy in place when it was bought for me by my mother and father. It was a sentimental policy that was put in place, and I just forgot about it for years. And the cash value grew to a pretty significant amount in that account. And I'm speaking a lot to a lot of people who are in the same situation. So if you guys are in the same situation, great. If you're not, you're going to have to suffer through this for the next couple minutes while I explain what it is that happened to me and what I think is happening to a lot of people out there who are misusing life insurance policy as an investment vehicle as opposed to the vehicle that it was intended to be for, and that is to satisfy a debt obligation or a way of life for your beneficiaries if something happens to you, all right? Now, the long and short of it is if you guys are wondering what I'm talking about with this cash account and you don't know how much you have in that cash account, that's probably your first mistake, all right? You really need to understand how much you have in there, and you need to understand what that money is used for, okay? In the event of your untimely death, that money is in there for one purpose and one person only, or one reason, and that is to fund the cost of the insurance so the policy does not lapse, jeopardizing your heirs receiving that face value. Okay, so for example, if you have a $100,000 policy, let's just say for example's sake, and something happens to you tomorrow, all right, and you just happen to have $25,000 that is built up over the years inside that cash account, inside that life insurance policy, all right, if something happens to you, somebody is going to call and they are going to come and they're going to pay out that face value of $100,000. Unfortunately, a lot of people don't understand that that $25,000 is absorbed by the insurance company, all right? You don't get that money. All right. So the net payout to your heirs will be $100,000 paid to your heirs, and $25,000 will be absorbed by the insurance company. You will not realize that money. All right. And that is so important for you to understand, is that if you have higher than average amount, or if you just forgot about that account for over the years, a lot of you guys, that might kind of be the savings under the pillow. All right. Or the money in the treasure box in the backyard that maybe has just gone under the radar for such a long time. And for a lot of people that I'm talking about, a lot of people didn't even know it was in there, or they knew it was in there and they were using it as an investment vehicle. All right. Now, if you're in that case and you've got 10, 15, 20, 25, maybe even more. All right. Now, these are real examples that I'm talking about. This very thing happened to me. Is that when I called the insurance company to really understand my rights under the policy, I had to get through 3 tiers before I spoke to the 4th tier of manager with the insurance company, and I actually had to pry it out of them, all right, as to what would happen to that cash value if upon my untimely death I wasn't around anymore to claim that money. Okay. And it wasn't till then that it was admitted to me that that money would be absorbed by the insurance company. Now, since I've done a lot of research on this, and if you guys want to validate it for yourself, I encourage you to do just that. All right. I think the bottom line is, for me to really protect you guys, if I have a piece of information that really can be kind of an unknown, or kind of go for years without actually having any attention put to it. We don't talk life insurance very much on the Independent Investor channel, but this is one of those things I really wanted to push out to you guys, that if you're sitting on a higher than average amount of cash in that, all right, you're not meeting the intent of what that money is for. All right. Now, the amount of money that you should have in that cash account should only be enough to bridge the gap between your untimely death to fund that account. All right. To ensure that the payout is made. All right. Now, in a perfect world, you will have absorbed or got all that money paid down to zero. All right. Now, the idea is that you don't risk the policy lapsing. All right, by taking it that close and actually going into the negative to risk the policy lapsing. All right, but you don't need $25,000 in that account. If you want to keep $1,000, I would even be as aggressive to take it down to 500, guys, because the cost of funding the insurance is only costing you just a few dollars per month. All right. And that $500 can actually keep that policy going for months at a time if you have a debilitating injury to where you can't work and pay the premiums on that policy. Okay. So a lot of you guys have way too extravagant amounts in those cash accounts. And I can tell you what, that cash account can be an excellent driver to start either a self-directed account for you or a self-directed account for you and your spouse. All right. So I wanted to get that out there to you guys. It's very important. It's kind of one of those unknowns. It's another one of those things that the powers that be, the financial institutions, especially the underwriters and the folks that are turning out these insurance policies to folks, will not openly admit to you unless you pry it out of them, okay? And that's exactly what happened to me, all right? And I've since done away with whole life, and I've gone with term insurance, all right, because it suits what it is that I've put the insurance in place for, and that was just a personal decision of mine. But if you guys are out there and you're sitting on some whole life policies with some fat cash values in there, you need to look a little bit more scrupulously at those policies and kind of entertain some options for yourself and ask yourself, is that an amount that I actually need in there? What is the cost of the insurance, and how many months am I going to need to buy if upon my injury or debilitating injury, I can't work, and to keep that policy funded in there? All right, guys. I just want to welcome everybody to the group. Thank you for coming in on a Saturday. I mean, it's just as good a place as any. A lot of new subscribers, certainly to the channel, especially within the last 5 or 6 months. The channel's really started to grow. We work our channel a little bit differently. And for the upload schedule, that's going to start to become a little bit more frequent. All right. I do have Jeff Worth in the group here, man. One of the plank owners and one of the co-creators on YouTube. I just want to welcome him specifically and also give him a shout out and congratulations. He just blew right past 1,000 subscribers. on his channel. So a special shout out to Jeff Worth. Anybody in the group here who's here tonight and who comes and sees this live feed after we're all done, certainly want to kick over and give Jeff some support. Runs a really good channel over there, man. I actually love the sincerity and the heart that he puts through in his message. And I think a lot of people resonate with his message for the same reason that they resonate with mine, because it's like sitting across from the dinner table and talking about stocks and finances, which is my favorite topic. So Jeff, welcome to the group. I also have Financial Investor in the group who's kicked into the group. Nice to see you, Brent. It's awesome. Some killer questions. Again, I apologize for the technical difficulty last night. I think I jumped Wi-Fi service unknowingly. So now I've got that locked down. I've got a devoted service, but I think I jumped service last night. But I do want to offer at the top of this, for anybody that tuned into my M1 review, I need you guys to understand, if I blow out some information with regard to a certain brokerage or a certain stock, all right, if I identify something that I want to offer to my group directly, I will hesitate nil to do just that. And I had a lot of positive things, and I still feel like there's a lot of positive things about M1 Finance. But there's one thing that's actually kind of a criticism of the platform, that just by working through the platform and executing some trades and some rebalance function through the M1 platform, I've noticed that I don't really like the fact that I don't know when that rebalancing happens. Now, if you guys can throw some, I know Brent does M1, he's been doing it a lot more than me. But if I'm wrong on this criticism, please let me know. But I'm actually considering opening up another brokerage account with Merrill Edge, who I've been with for years. The verdict is still out a little bit. I'm down about 10% in my aggressive portfolio in my M1 Finance account, which is totally fine. I'm not worried about that one bit, but I will not liquidate unless I get back up into the black. But I'm actually seriously considering switching back to my Merrill Edge account. What a lot of you guys don't understand is I trade for free in my Merrill Edge account. So anybody with less than $50,000 is going to have to pay for those entry and exit fees, all right? And M1 allows you to get exposure to the stock market free of charge, just like Robinhood, all right? But also it allows you to do so in a retirement account, all right? So just one negative criticism that I want to throw out there, and I'm not one of those guys that wants to push out content through YouTube because M1 is the next best thing, and keep my negative criticism subdued for the sheer fact that I just put out a video saying that it was the best beginning account, which I do believe that it is. But that is one criticism that I've seen of the platform, and I'm actually seriously considering going back to my major brokerage house with M1 Finance. If anybody else has experienced that difficulty with the M1 platform, I'd really like you guys to let me know. I have had one of my subscriber base hit me up and talk to me about how dissatisfied they were with the customer service. I can say that I did not have that experience. I thought they were pretty good, not quite as professional as if you call Bank of America. All right. I've been in the Bank of America building in downtown Manhattan, and that is a top-notch bank. It is one of the top banks in the world. Okay. And I do not mind having most of my investment eggs in that basket. All right. So I just wanted to offer that to the group with regard to my criticism of M1. And I'd like to hear anybody in the group. I've got Les in the group here as well. I know he actively uses M1, if I'm not mistaken. M1 is their account, and it's good for those folks out there who really don't want to incur, or they want to start their portfolio and not incur a bunch of fees at the beginning. Another thing that I kind of wanted to talk about a little bit was I get this question all the time, and I render my answer all the time. And it is one of those critical questions that you guys need to really answer for yourself in your searching of knowledge in the stock market. And this is going to be my best breakdown of the difference between a Roth IRA and a traditional IRA. All right. Now I'm going to spend just a couple minutes on this topic. All right. We will not be discussing the prospect of a backdoor Roth during this discussion. That's a whole nother dialogue that can be had in another day. And quite frankly, I would probably bring in the services of a tax accountant if a backdoor Roth, which is absolutely legal and probably the best way to time both the benefits of a Roth and a traditional, if you put them together, to enjoy the benefits of a Roth up front, or excuse me, a traditional up front, and then switch it to a Roth at some point at a magic break point in your life, okay? But the reason why I'm very, very keen on offering the prospects of investing in a retirement account, and anybody who did not see Ernest McCamey, who is now an administrator within my group. I've got a couple of them in here. I've got Jared Odell in the group here. Hello to you. I do have Ernest in the group as well. I've made those guys administrators in the Facebook group. They have the exact same privilege as I do with regard to granting permission, allowing certain posts, kicking people out of the group for haven't had that. I've only had about a half a dozen folks come and act a fool, and it's not a platform to do that. But he actually offered a very, very good piece of content in the group here recently about the right order of investing accounts. And if you guys haven't looked at that, I highly encourage you to look at that order, because not only does he give his order, but he gives the rationale behind why he offers that, okay? But the reason, really put quite simply, why I push out the Roth IRA first, okay, is we don't know what the tax rates are going to be in the future, all right? And there's very few guarantees in the stock market, okay? A lot of what we talk about are opinion related on the Independent Investor channel. A lot of it is fact, okay? The fact is, in a Roth, you know, we're hoping that our community turns the page and we end up, you know, working, you know, a prosperous life, and we end up to be 59 and a half, which just so happens to be the maturity age for contributions and earnings to be withdrawn from the Roth IRA account when you reach 59 and a half. Okay. Now there's no required minimum distribution that needs to be taken at 59. That's just when the account is eligible. All right. The reason why I like it so much is we do not know what the tax rates are going to be in the future. Okay. We just don't. All right. So it's so much better now to pay the tax on every $1 earned. All right. We pay the tax on it now. So your obligation to the government is done. It's out of the way. It's done. It doesn't matter if you can take that $1 and for every dollar you invest, you turn that $1 into $100. Okay. Remember, you've taken your obligation on the $1. If it turns into $100, as long as you're at that eligibility age of 59 and a half, that $100 can be withdrawn. Okay. Now, keep in mind, this contribution of $1 can be withdrawn at any time. All right. With no penalty. All right. But I always hesitate to give that piece of advice to a new investor who doesn't like the idea of putting their money away and just forgetting about it indefinitely. And that's really the mentality that you have to prescribe to when you're looking to become an investor. Okay. If you want play money on the side, have play money on the side. If you want budgeted sunken costs, gas, food, fuel, etc., clothes, whatever's important to you, keep that stuff separately and in a different category than investment capital. And I want to make sure that the investment capital is being invested in you first. All right. Always pay yourself first. All right. So when we're looking to get a Roth IRA started, all right, we do that to cap the tax rate in the future. And those contributions that you make in the Roth IRA over the years, you're going to notice that you've already paid the tax on it. You cannot take those contributions and reduce your taxable income. All right. You're going to have to take that hard-earned dollar that you've paid the government your tax benefit for. All right. And you're going to have to contribute that $1 and defer your benefit to the future. Now, what the deferred benefit is that you're hoping to take that dollar and turn it into something greater than what you're investing. Okay. I'm trying to keep the example very simple by talking about $100, or excuse me, $1 for every dollar invested. All right. Those dollars have the appreciation potential, right? It can be paid dividends, all right? However you tell that $1 to operate in the stock market, once it's funded in that account, all right, it can grow as fast as you can make it grow, all right? Remember, the faster you try to make it grow, the more risk you're probably taking on to make it grow. So we need to find kind of a happy medium to the risk that we put on growing that $1, right? So we're eligible to take those contributions someday tax-free. All right. Now, on the flip side of it, we've got the traditional account. And you notice that for a lot of people, a traditional account can be a traditional retirement account can be an excellent avenue to reduce your taxable income. All right. So it can be very beneficial to reduce your taxable income now if you're just on the cusp of a certain tax bracket, and it allows you to get that tax bracket lowered, all right, into the lower tax bracket by reducing your taxable income, all right? So for every dollar you contribute, you're basically taking that tax benefit up front, okay? So now instead of deferring the tax benefit on that $1, you're taking the tax benefit up front. You're saying, government, I want you not to tax me on that dollar. I want you to tax me in the future, all right, at the effective tax rate. Now, the traditional account is the one where minimum required distributions are due or required at 70.5. Why? Why is that? It's because you've reduced your taxable income and said, government, I want you to reduce my taxable income now, and I'm going to pay my tax later, okay? It's called the deferred benefit, all right? The problem is you allow that dollar to grow for 30 or 40 years, and you're having to pay tax on a much larger amount later on in life. Now, we do take contributions from that, and it is at the effective rate later on in life, not the marginal rate now, okay? Which can be a significant benefit if you take it up front, all right? But that's typically why I don't necessarily like recommending the traditional unless you've determined with your accountant that reducing your taxable income is more beneficial to you now than it will be in the future. All right. And that's really kind of it for the traditional and the Roth. And you're not going to get all this from one sit down, but it is worth opening up the envelope of discussion on understanding your benefits and understanding the differences between the two accounts and picking the right account to make sure that you get the maximum benefit out of the account you choose. All right. Now, with all that said about the Roth and the traditional, all right, most people will opt for the Roth account. Okay. The Roth IRA. All right. They will understand the tax benefits and the tax protection in a Roth. All right. The problem that I talk about all the time, and this is just one nerve of benefit that I push out on the channel, that they take that Roth IRA and thinking that they're doing the right thing, and they subject it to a managed Roth IRA account. All right. And that right there is one of the single biggest missteps that a new investor can take. Instead of deeming that Roth IRA your benefit that's bestowed upon you by the US government. Guys, I've got guys hitting me up from other countries that do not have this benefit. All right, they don't. All right. So Americans have to be educated on taking this benefit and basically opting out of the managed fee structure within most accounts. They're basically attaching their fee structure to your benefit that you have earned as a citizen, right? If you opt into that and you look to contribute to, you've earned it. That's your benefit, all right? If you contribute $100 a month to this account, all right, you're almost realizing back 25% of your benefit that's due to you at a $458 maximum funding schedule, right? $5,500 a year can be contributed to this, all right? But if we're taking our beautiful Roth IRA and thinking that we're winning over here in a managed account, this is what we're trying to liberate people on and getting them started in the self-directed account. Because if we take the same ETFs, VOO, and we put the same 70%, 30% allocation in this account and the exact same allocation, exact same holdings in this, the only difference is this is a managed account and this is a self-directed account. The self-directed account is going to blow this out of the water the longer you hold the accounts. And it can be mind-blowing in the amount of hundreds of thousands of dollars of different only by making this one strategic misstep in opting for a managed account or unknowingly opting into a managed account as opposed to opting out of the fee structure in a self-directed account. And that is really why we profess and teach upon those lines, to go ahead and take a passive approach. And by nature of the account that you choose, you're going to win in the long term by opting out of the managed fee structure, guys. So that was something that came through. I hope you appreciate that. I'm going to kick back up to the top here. I've really got a lot of folks in the group tonight. I appreciate your involvement. I've got Benjamin Levy here. Yo, yo, yo. Again, that's his tagline. That's his big saying. He's probably going to beat me to 100,000 subscribers because he's got a killer tagline and I don't. He needs to shoot me a good one that I can start to use on the Independent Investor channel. Everybody says I need one. I tend to disagree. It's not really my style, but nice to see you, Benjamin Levy. He's in the group here again. I've got some guys here. Hey, Ryan, just wanted to pop in and say hi. Again, Jeff, a shout out to you and congratulations. Doug Whitaker, my magician, stock investor, has 100% wins on every stock he invests in, and that is fantastic. Good to see you, Doug. Happy Saturday to everybody. Keep dropping truth bombs. So much financial confusion out there. You guys should have seen my rant about Jeremy picking up, what was it, $10,000 worth of Tesla last night. It would have been a beauty had it actually caught, because I went on for 25 minutes with my computer and didn't know that it wasn't filming. So my live feed got cut short from an hour down to like 37 minutes. So I do apologize for that. I actually hesitated putting it on there, but there was some good content in the beginning of that, and I felt like it was worthwhile to go ahead and throw online. So that's what I did. Yeah, $10,000. I hope it works out for him. I really do, but I think that's a really risky move to be putting on a company like Tesla right now. So, and that's really the idea. The idea is not really to call it truth. I really like it more to be looked upon as more of a testimonial, because these are things that I do. And I typically don't prescribe to one methodology being right or the other being wrong. Really, one of my rules of thumb in stock investing or whatever, whether it be Jeff's perspective or whether or not it be my perspective, at the end of the day, whatever perspective makes money, you're the winner. Really, at the end of the day, this is a money game. Okay. And people who prescribe to the channel and subscribe to many other channels, hopefully you kind of have that drive and motivation within yourself, not to be entertained, but maybe to extract a little bit of value that you can deploy in your own lives and make you that much sharper upstairs. Because this is not one of those games that you understand and you're done. Okay. Money and financial savvy is one of those things that is an evolved art over time. And you will live on this earth and you will die still learning about finances, just like a lot of other things, okay? But finances is absolutely one of those things that you will continually evolve. And if you guys have tuned into my message since the beginning, just under a couple years ago, I have also kind of fine-tuned my approach and evolution of my message, in that I'm really trying to strike at what is it that I can throw out there to help individual investors that don't know anything about the stock market. How can we make this as easy as possible? And who can have the most potential, right? Even with their self-deprecation and mental barriers saying that you can't do it, that can hear my message and say, gosh, Ryan says I can do it. Maybe I can do it. And then deploy those ideas and find out that it's probably not as difficult as they thought it was in the beginning. All right. Outside doing yard work with the kiddo, just listening in. That's awesome, man. I miss doing yard work, actually. It's been a couple tour transfers now that I've actually owned a home and can barbecue in the backyard. But we're going to shelf my happiness for just a little while and maybe settle somewhere someday. All right. But that's the eventual goal. One of my personal goals, to settle somewhere with a piece of land and build the house that I want. That's one of my major drivers of my goals. And that's, I encourage all you guys, not let your goals consume you and burn you up, but definitely use your goals to motivate you and validate why it is you do some of the things that we talk about on the Independent Investor channel in building a good, firm portfolio and approaching the stock market like a war, because it is. And I mentioned in response to the Tesla purchase, I think he's BSing, to be honest with you. I don't think he actually did it. But if he did, that's wonderful. I've got enough experience in the stock market not to play with the stock market. It's not one of those things that you can play with and not get burned. No way. No way. I take my investments very seriously. I take my recommendations even more serious. As a matter of fact, I could just come on here and give you my personal investing strategy, all right, with no deviation whatsoever. And I think a lot of people would take that information and they would fail, all right? What I'm trying to do is deliver a message outside of my personal approach and perspective. Now, there's roots and themes that I give you guys that are absolutely in line with what I do, okay? But it's not appropriate for you to deploy some of the strategies that I deploy in my financial approach for somebody who has, you know, a couple $1,000s, let's say $2,500 of starting capital. It's not prudent for you guys to hear me out and say, gosh, should I trade, you know, stock right away? No, you become an investor first and get yourself some mileage underneath you. And at least I want for you guys to understand and resonate with my message that it is inevitable, okay, that markets do go down, all right? And we've become way, way too complacent on this stock market in just, hey, I'm just going to throw money at this stock. I'm going to throw $10,000. Guys, where I come from, $10,000 is a lot of money. It's a lot of money. And I know there's people out there that will hear my message and actually sit across and be like, wow, did he just say that? Yeah, I'm saying it because I actually feel like $100 is a lot of money, all right? And if you want some perspective on how valuable your money is as an American, I highly encourage you to go to another country and validate it for yourself, all right? And so it's one of those things that I really want you to take away from this is that everybody should invest. Everybody should become a participant in the stock market, but don't ever, ever get complacent on the stock market. Don't ever, ever get arrogant in the stock market. Always remain defensive and offensive at the same time, okay? You have to think dual purpose. What if the stock market continues up on its bull run? What if the stock market actually goes on a 20 or 30% correction? Because I actually think it's closer than what a lot of people think. And it's better to talk about it now than after it happens, because after it happens, you're done. You're holding, okay? Selling is off the table, all right? Defensive positioning and selling is off the table. The only thing that you have is to either buy more or start building your cash reserves in that corrective downturn, all right? Hey, Ryan, my former advisor from my father inherited an IRA, called me and wanted to see if there were reasons why I transferred the entire account out of the institution. You had a big part in it. Thanks. You're very welcome. I hope my advice was prudent. I've dealt with that very same scenario, and I would love to just give you all the advice in the world. I'm not a financial planner, proudly enough. And furthermore, in your case, I'm not a tax accountant. And there's way too much legal implication when you have that going on. So I do not hesitate nil to give that type of advice, because it's the same advice that I gave when I had the similar situation before. Very sad situation, actually, where a young person actually had father die, and another young person, a colleague of mine, had another a mother pass away as well. But the same situation, that dealt with some inheritance, some tax protected accounts. I believe in one of the cases it was a traditional account. One of them was a Roth account. So there's some transferability issues there. There were options, but they were limited options, and those options needed to be explained from the tax accountant in conjunction with the holding brokerage account and the receiving brokerage account. So glad to help. That's what we're all about. And, you know, in a community setting, I tell you what, it's amazing to see a lot of these answers coming back to a lot of new folks popping into the group. I'll answer a question my way, and then I'll have Jared kick on the line here and answer it his way. And then I'll have Adolfo kick on and kind of offer his perspective. And then finally, Ernest, you know, who's just been great offering his technical perspective. I really I hold those guys in very high regard with helping out, because it gets kind of consuming for me as an individual. This is why I started the channel, to be able to touch many people at the same time, because I got kind of tired of talking to every single person that I would meet and strike up a conversation about finances. And they're just like so energetic to know what it is that I have learned over the years. And so this provides me that platform to provide it to many people. Now, the plank owners of the Independent Investor channel certainly have an obligation to go out there and share it with family, friends, those folks that, you know, I can't reach directly, okay? And that's the indirect piece, and really a lot of the strength and excitement that I have on the channel in building the channel via referral, okay? I put most, if not all, the value in the folks that come and subscribe to the channel in the referral process, okay? To put it quite frankly, I don't want a bunch of idiots on my channel who are just coming on with no vested interest whatsoever in enriching their own lives. I really don't want any part of that. I don't, all right? Glad to help. Good information, Ryan. Something new. Yeah, it is. It is. And it's kind of boring. It's not the most extravagant topic. Talking about life insurance is not something that I want to be a Debbie Downer on a Saturday. I'm actually in a killer mood tonight. And kind of to make up for last night's live session, to put it quite frankly, I was kind of upset last night because I feel like I've got kind of an obligation to the group to deliver and offer some answers to your guys' questions. And I had a whole scroll of questions at the end of the group that I didn't get to address because I went offline. So I will offer, I had some stocks below $50 that I was going to throw out there to the group last night, and I don't think I got to. I'm going to run down that list right now. A lot of people are talking about, you know, should I buy Google, or how many shares of a particular stock can I own? I throw these out there for starting positions, and ironically, one of these positions is AT&T, and that's one of the very first stocks that I owned. I bought it at $22 a share some many years ago, and here it is at $32. I watched it go all the way up into the low 40s. And I own 100 shares right now of AT&T. You guys could incrementally step into the position. 10 shares at $320 at a 6.5% dividend is a good entry point for AT&T. Cisco is another company right now, had a killer quarter last quarter. An excellent dividend payer as well at 2.5%, 2.58, I believe, on Cisco. But Cisco, I would consider actually a cornerstone in your guys' portfolio. So again, be it at less than $50, you know, you're talking about a 10-share position at less than $500, all right? Cisco can get it done for you. Pfizer, I'm hot on Pfizer right now. Pfizer and Merck will both get it done for you. Johnson & Johnson is going to be in the dividend list that I'm going to throw out to you guys as well this evening. But Pfizer has been on kind of a tear. It's moved from 36 to 42, and you think, okay, big deal, Ryan. That's a huge deal for a value investor to take a move from 36, which has basically been stuck in the mud, and move to 42 this quick. And it's kind of broke above some of the multi-year support levels that it's had in the mid and low 30s. And it's at 42 right now. And I see actually pretty good upside potential in Pfizer. If it does correct back on you and you take a haircut in it, you're still making a fat dividend with Pfizer at 3.5%. All right. Intel is another one. And I hate to even recommend chips right now. Actually, I don't, because AMD has been on fire. It's been the darling of the chip group as well. I certainly give a shout out to my friend Ryan Scribner, who's probably up well over 100% in AMD. He called it. I told him to be careful. I was wrong. He was right. Again, just another example of making money is the end game here. He took the risk in AMD, and I think he bought it below sub 10, I believe. And here he is approaching $30 a share. He's made killer money on that. That's a fantastic return. But Intel, as a major chip company, actually is probably thrown out with one of those recommendations that I can make to take a small position. If you're looking for exposure in the technology sector, I would look at Intel as a stock less than $50. Mondelez, ticker symbol MDLZ, snack producer, spun off of Kraft some many years ago before they acquired Heinz Ketchup. Mondelez, I'm very high on. Ratings high across the board. It's been building support in the high 30s, low 40s right here for quite some amount of time. It's actually a very good dividend payer. It's a very good diversified snack play. And it's got a lot of exposure in Europe as well. Okay, it's mostly overseas, if I'm not mistaken. But Mondelez is a good name for a beginning investor to look at, maybe taking even just a 5-share position, right? You're talking about a couple $100 in a quality, huge, multi-billion-dollar market cap. I think we're looking at about 75 billion, 50 billion, somewhere in between there for Mondelez. We're talking about a huge company. Comcast right now. Comcast in the telecom sector, we're talking about $80 billion in market cap. Comcast trades at around $36, just around, I think it's right around 7 times earnings right now, which is really, really reduced. I watched it in the mid 40s. I watched it creep close to 50. It went all the way into the low 30s here and at about 36 right now. You could take a small position, get yourself some telecom sector. Remember, I try to keep the telecom at around 3% in a portfolio, so it's not one of the bigger weightings in your portfolio. Technology, it should be that biggest weighting at 20%. All right, healthcare at 15%. So all those rules apply to when I'm throwing these stock picks out there. But it's just kind of fun to kind of hear my topics. And the last two, Coca-Cola at 3.5% dividend. You're looking at a $42, $44, $40, $45 entry price. I just checked this stuff before I jumped online for you guys. But a good diversified portfolio. Now, the problem with Coke and Pepsi, obviously, is that they've got the unhealthy legacy businesses, and they're really trying to bridge the gap between more healthy alternatives, both Pepsi and Coke. But Coke is a really good blue chip company, one that you could take some exposure to, own it for the long term, set it up again in a self-directed account. It's going to dividend reinvest for you. And it's going to pay you every single quarter to own the stock. And finally, probably a better buy than Comcast, a stock that I've owned for years, and it's kind of looking like it might be starting to get out of its own way, is Verizon. All right. Verizon is a fantastic, it's a well-run company. It pays a very, very healthy dividend. And it's just over $50, but I did want to include it because it spent a lot of its life here within the last couple of years, sub 50. All right. And at $52, $53, $54, all right, 10 shares at $540 gives you a nice starting position and a nice dividend payer in Verizon. All right. The really kind of AT&T is the biggest telecom provider. Verizon is right behind them. But that'll kind of get you guys done. I did talk a little bit about realistic expectations, but I do want to get to some more questions over here. See if I can pick something out. I told him the fees were strangling my father's account. That's so true. I just, the awareness to fees, and I don't mean to scare people, but it's the approach that I've taken since the beginning of this channel is to avoid fees at all cost. No pun intended. No pun intended. The misconception in the industry when you're just starting out in the stock market is, number one, you think you have to seek representation. Number two is you don't have short-term validation to understand why in the hell you're investing in the first place. And a lot of people will get started in the stock market and a couple months will go by, they'll take a haircut of 20% and they'll sell, or the stocks will go up 20% and they'll sell. All right, because they just want that short-term validation, or they'll watch the stock market for 4 months and their holdings will not move. And they'll wonder why in the heck they're doing what they're doing. And they'll question their program. They'll question the validity behind it, and they'll pull out of the stock market. And that's one of those things that by looking at forecasting, I offered the compounding calculator video earlier on last week to give you guys kind of an idea of the power of mathematics. And even though it is a linear example of where your money can grow, I actually feel like there are some impulses that you can actually put a little bit more of the odds on your side by strategically buying the compounding effect when the stock market goes down. Okay, so you're not adding on a schedule and buying some high and some low. You're actually strategically buying the market, maybe adjusting your buy point by a few days and buying all of your stock on a red day. That's what I do, okay? Over the years, it's made a huge, significant difference in deploying that. Really, I call it strategic buying. And I've never heard that term before. I'm pretty sure I'm the one that made it up, because most people want to go with dollar cost averaging. Okay. Now, in a managed account, you're going to get charged to become part of a dollar cost average program. All right. I throw out the 5 3/4 basis points of fee attached to most of the dollar cost average programs. And most of the financial planners will put you into multiple funds to make sure that they can get that 5 3/4 basis points on every single transaction every single month. It's absurd. Okay, it's absurd. It's something that you can set up on your own. But if you didn't want to do a dollar cost average on a schedule, you could fund the account and have it ready to buy. And within any given week, you usually have 1 or 2 opportunities to buy the market at a triple red day, right? A triple point red day. And I try to do most of my buying when it's like 2, 3, 4, or 5. When it's 600 or 700 points down in any given day, I'm licking my chops. Okay, that's really where I'm stepping in and actually pursuing a little bit heavier buy points, because I figure over the course of my life, if I've consistently looked at buying the market when everybody else is pissed off and running for the hills, then I'm doing correct. And I've done nothing but validate that that program works over the last 10 years or so that I've actually deployed that strategy in the stock market. Okay. So I'm glad. I'm really glad to help. I just picked up 70 shares of AT&T in the low 32s. So I've got Hector, who's probably added a really nice position. Look, you're going to pick up 6.5% in your dividend while you wait this thing out. But I've seen it kind of form a base here at 32. And all this time, it's been really, really quiet with their acquisition of Time Warner. And that's why I'm holding firm on the shares. I'm down about, it's one of my fallen angels for this year, but I have a feeling I'll be doing a video back in the black on AT&T when it gets up above north of 40 again. All right. And I'll continue to rake in the 6.5% dividend while I hold the shares. All right. Because that red down 12% means nothing unless you sell. Remember? All right. Strategic. All right. You do not have the ability to take back a hand in a casino and say, can I have a different card? And that's the beauty of the stock market, is that you can play a hand until it's a winning hand over and over and over again until it becomes profitable for you. And then you can walk anytime you want. That's the beauty of investing. All right. Do you think Twitter will be a good stock down the road? Probably, because I use Twitter and I actually like it. It's really one of my primary sources. You guys know that I do have my independent investor channel feed through Twitter. I don't put a lot of personal tweets on there. I'm waiting to build up the Instagram account to do that, to give a little bit more exposure. But that's going to come down the line a little bit. But as far as like the social media landscape, Facebook is taking it on the chin. And of course, Twitter's taking it on the chin now as well. But I actually think Jack Dorsey is making some killer investments in the company. And I don't want to underestimate the power of the social media platforms now, because I think in 10 or 15 or 20 years down the road, these suckers are going to be, we're going to look at these stocks in the 30, and Facebook right here at this recessed value at 160, trading at 25 times earnings. And we're going to say, wow, I wish I woulda. And I've done it a lot in my life. I've got a lot of I wish I would-haves in the market. And Twitter will probably be just that. I would prefer Twitter over Snapchat. Okay. I think Snapchat has some real problems. I didn't like it at all. I know there's a cult following behind Snapchat. But if I were going to take a small, aggressive growth position in a social media company, I think Twitter is right there at the top of the list, right behind Facebook. Okay, that's a good question. Thank you. I've got 1-0. Jared Odell says, good evening. It is a good evening. Just relaxing, taking some time to decompress before this storm hits the East Coast. So I appreciate everyone's involvement here. We're going to continue on with the questions, and I'm going to kind of get to kind of a premise of a video that I'm going to release, where I'm going to release my top dividends. I have 11 stocks for you guys with regard to what can go into a dividend portfolio. You guys are going to find a little different approach in how I deliver these videos. I'm going to try to cut down on the time that of which I do not have to sit there and rant for 10 or 15 minutes. I would prefer to do that, honestly, but I'm going to kind of change up my approach a little bit and get even more aggressive on making it content driven. That way, the receiver of the message can hear what I have to say in 10 minutes or less and really come away with some savory information. Okay. And I've got a bunch of it. The topics are infinite that I've got built up in the Independent Investor Chronicle that I haven't done, some stuff that I have done that I want to re-deliver to you guys along the fundamental line, along the philosophical line. It all helps getting that reassurance for a new investor that you're doing the right thing. All right. I've got 1-0. Ryan, what's your opinion on JD? Is it a buy? Yes, it is. Or should I stay away from Chinese stocks? Contrary to the opinion of Jim Cramer, who he said should stay away from Chinese stocks right now. It's what the most disappointing name isn't JD.com right now. It's Alibaba, actually. Really disappointing the price action in Alibaba. Kind of disappointed that I actually took a partial position. I'm strategically buying Alibaba with JD.com in my M1 account, as you guys well know. But I think JD is oversold right here. Alibaba trades at a pretty high multiple. It also has, 10 times the market cap as JD.com as well. But I own them both, and I own a very small position. Okay, you guys have to understand, if I'm going to say, yeah, JD.com is a good stock, I'm not one of those guys that says, yeah, take $10,000 and invest it in JD.com. I think that's absurd. If out of a $10,000 portfolio, you wanted to put a couple hundred or maybe $500 maximum into a JD.com as a short trading position, absolutely go ahead. It's a tradable stock. It's also an investable stock. Okay. What I mean by that is you better buckle your seatbelt and be ready for some volatility, because I'm not calling a bottom in Chinese stocks right now. All right. So I would just be careful playing with that right now. I'm happy with China Mobile. I'm almost back up into the black on China Mobile. So I don't know what everybody's crying about. I have no problem with buying into an Alibaba. I watched Alibaba go to $210 just a couple months back. You guys remember that? It's all the way down to 160 right now. So for me to say, well, it was a good buy at 210 and it's not a good buy at 160, we're doing the reverse philosophy of the way we should be approaching the stock market. And if Alibaba or JD.com is one of those stocks that you've wanted to take a conservative, right, aggressive, but conservative on the dollar side of it position is, I give the green light to do just that, especially if you have a long-term horizon, because Alibaba is going to grow over time for sure, as well as JD.com. And I think at 27 bucks, it's a bargain right here. All right. Hey, Ryan, they told me it happens on the next trading window. Correct. That's exactly what I've identified. And this perspective comes from someone who's traded on the Merrill Edge platform for quite some time. And I do want to premise that when I go in and I trade in my Roth IRA or brokerage account, I trade on a dime. Okay. I don't pay any fees in the account. It's not so much the trading fees that I'm so concerned with. It's just the fact that when I want to execute a trade and I've locked in, I've sold stock and locked in $50 worth of profit. Why not? Why? Because I can do it for free. And I don't really like putting in that rebalance order and then just waiting until the next trading day for it to rebalance. I really think that's somewhat of a deficiency for me in evaluating the platform. That doesn't mean that you need to liquidate your M1 account. Certainly not. As a long-term investor, you can hold true in M1. It'll get it done for you. That's fine. It's just that once that account starts to grow, is that a functionality that's going to bother you into the future? And that's why I say all the time, you got to make sure that you're buying an account that you're going to be happy with long term, because getting it liquidated and transferred over is doable. It's just kind of a pain in the neck, and it's something that you can avoid if you make the right decision up front. But I'm going to let it play out. I really am. It's just a testament to how happy I am with the Merrill Edge platform that I do recommend to you guys. And I think if I had it to do over again and I was a brand new investor, I would pick one of the major brokerage houses, no screwing around. Merrill Edge, TD Ameritrade, Charles Schwab, Fidelity. All right. Pick a major brokerage house. You're not going to be disappointed. Start the self-directed account with them, and you'll probably be happy for the long term. Okay. I do put M1 in there because M1 allows that avenue of free investing. Okay. And that's a big deal. All right. Because when you don't have a lot of money and you start investing, I would rather see you start and be excited about, the prospect of entering into stock ownership for free, as opposed to looking at a $7 trading fee and be turned off by that. Do you see what I mean? That's why I don't hesitate to recommend the M1 platform. Extremely high on my list, I might add. Hell, I'm still invested in it. I'm not going anywhere. All right. Thank you for that comment, Les. I really appreciate it. I think for you guys with multiple accounts and multiple avenues, I think it works really good for you guys out there, and it'll get it done for you. It's a good one. You can buy any individual stock and choose dollar amount and have never had a rebalance occur. You're probably smarter than me. I should probably stop hitting the rebalance button. I did it once because it just wasn't built the way I wanted it. I wanted those allocations and those 10 stocks that I owned to be exactly what I wanted it to be. All right. So I could probably just let it run and not have to worry about it so much. But it's kind of odd that maybe I haven't learned the functionality quite good enough, in that if I wanted to sell an individual stock for a profit, I could. I just need to get more familiar with the platform. I will play with it more, but definitely taking all your comments into consideration this evening, and I thank you for that. M1 usually trades around 10 a.m. Central. Becky, thank you for that. I didn't know. So I kind of saw the rebalance in there thinking the whole time, and I was like, what's going on here? So that's really good to know, Becky. Thank you. I appreciate that piece of information. All those little pieces of information we put together to make a collective whole, and that's the beauty of the community that we're looking to promote here. I've got Rohan on the line here, one of my old school plank owner friends of the channel. Kind of feel like I've never met some of these guys. Someday we will all meet in Las Vegas for a big week-long retreat. I have set the seed for that, and that will be a goal 10, 20 years down the line, maybe. Who knows? Maybe 5. I don't know. I've got some folks that are telling me to buckle my safety belt because they think that the Independent Investor channel may end up going somewhere. We'll see. We'll see. I would love nothing more than to see a project of mine succeed. I do believe we're reaching people, but that is definitely not why I started the channel. I believe that the sincerity of the channel is the very thing that has got me through some of the hard times in starting a YouTube channel. And trust me, if you want to test your fortitude in life, start a YouTube channel and tell me how easy it is. I think Jeff, if he's still on the line, or Brent, or any of those other guys are still on the line, they can attest to how difficult it is. But I think we're in a groove here, and I think we're delivering quality content to the people who I have aimed the message at. And if that ever gets compromised, I will shut the channel down. It will cease to exist anymore. I actually believe the opposite. I believe we're helping a lot of people get the word that a lot of people, I feel, do not understand. So, hey, Ryan, wanted to have your take on Alibaba after Ma's exit, and do you think one should fiddle with the 401k account or just stay invested with the funds invested by the company? So that's also one of the really, really important questions. I got an excellent question from one of my new group members in the Portfolio Solutions group, kind of along these lines, and it sounded like this individual had some discretionary cash. The question was, do I maximum fund the 401k at the expense of starting an additional self-directed account? All right. You guys know that the self-directed account offers benefits that are unparalleled. Okay. So for me, there's a tipping point beyond contributing to your 401k and getting that company match. If you contribute more and more and more, your company match is going to be maxed out here. There's going to be a ceiling set on that company match, okay? Now, I'm not saying that this additional contribution, if you have the means to do so, is a bad thing, okay? It's not, all right? But there is a tipping point for me where Why are you working so hard and killing yourself with the stock market at an all-time high, and you've still got your foot on the accelerator in 6th gear investing in your 401k? Why not throttle back a little bit, all right? Downshift that account a little bit. Still contribute to get your free money, all right? Get your maximum match, but throttle back on some of that surplus and bring it in line with still getting that maximum match. So you're contributing here, you're getting the maximum match here, and rolling some of that surplus over into either a savings account or starting the self-directed account, okay? Why do we recommend that now? The market at an all-time high allows you the opportunity to make maneuvers like this, okay? It gives you the freedom to do that. It doesn't give you the freedom to just go buy $10,000 worth of Tesla like an idiot, okay? It doesn't, all right? What it allows you to do is strategically look at your program and potentially identify areas that you can improve upon, all right? Now, by decelerating the 401k contributions, I've had a lot of people hit me up and they're like, Ryan, I'm max funding my 401k, but I've got some debt over here that's killing me, right? Throttle back a little bit here. Why? Because you have to have the opportunity to do so and start to pick away at that debt or start to build some of that cash or strategically identify the need to start a self-directed account for you and your spouse, right? And get those starting funds started. Take some of that surplus, right? Start the dollar cost average program and just start funding those accounts, all right? You don't have to invest anything if you don't want to. Let the amount build up to $2,500, right? Fund that account over time. And you'll be amazed at how quickly you'll get those 2 accounts or 1 as appropriate up to that first $10,000 threshold that I talk about all the time. But that's a really, really good question. I do want 401ks to stay in place for most people, okay? I think if you've been working in your employer for a long time, you absolutely should be one of those people who are contributing to. There's a lot of people who don't even contribute to it. That's crazy. That's crazy. Why? Especially the ones that are giving free money. It's not one of those things that I look at as optional. I don't. It's required. If you have a 401k, especially a good one, the problem that I have when I look at a lot of people's 401k programs is that they're built to be confusing as hell. It's irritating to me. It is. Because you have to log into the account. If you don't have an HR department to help walk you through it, you've got to log into the account and answer a lot of questions by yourself. And for a lot of people, that's intimidating as hell. All right. They don't want to do it. They don't want to just log into their account and start maneuvering funds because they're afraid that they're going to hit the magic button that's going to self-destruct their 401k, right? I'm being a little bit facetious, but in all reality, people don't want to log in and do something wrong. They don't want to pick the wrong account. They don't want to take responsibility for their own actions. And I'm telling you, that's exactly, at the very least, what you need to do is understand that if you've got a 401k that's sponsored by Vanguard, offered through your employer, that's really one of the best that offers them. So you owe it to yourself to at least log in and make sure that you've got a nice, diversified, pick a target date fund. I don't care within your 401k. All right. It's probably not going to perform gangbusters every single year. All right. But you're going to get some slow, diversified growth, right? It's going to be invested, and that free money is not to be overlooked. It's not. That's why I stress upon it. All right. So continue to invest in the 401k. But if you do have the means to maybe throttle back, take some of that surplus and start the self-directed account, it gives you that freedom and flexibility to take that self-directed account and maybe make a stock account. Why not? Make a dividend portfolio out of that stock. Buy some big blue chip companies and put that stock portfolio to work and fund it over time as you fund your 401k. Now you're an investor. Now you're an investor. I'll be the first one to pat you on the back. Awesome question, Rohan. Thank you. I hope I hit that. Hello from Ireland. Frankie, I've got Frankie from Ireland. I will have you know, Frankie, that Ireland is probably really high on my bucket list, and you're very lucky. It's great to have you on board. I don't know what time it is there in Ireland, but I'd have a pint with you, man, if I was over there with you, for sure. I met some people from Ireland when I was up in Alaska, man. They were up there doing some sport fishing, and they were some of the coolest people that I've ever had the pleasure of having a drink with at the bar, man. Very cool. Give a shout out to Ireland for sure. I've got Baby Cakes with the next question in line here. For next year, I feel like I should just stick to Vanguard's large, mid, and small cap. What do you think? Yeah, it's a fantastic plan. Specifically, and thank you for the detail in that. It allows me to elaborate a little bit more to help you fine tune what it is your plan is and what you can kind of expect with the stock market over the next year. I would still like to see the majority of your weighting in VOO, the S&P 500, okay? The VO is the mid-cap ETF offering through Vanguard. Certainly take your remaining 30% and split it. Maybe do 20% in the mids and 10% in the small cap. You could do something like that, but I do want to see the majority of the holdings in the VOO. One thing you could strategically take to build this portfolio up safely is investing in these passive ETFs over the next year or 2 or 5 could get very, very interesting. All right. Let me be frank. It may get very volatile. Okay. I'm not one of those guys that wants to blow smoke at people for the sake of entertainment. I am not an entertainer. I'm really not that funny. Okay. I'm really not that good looking, to be honest with you. But I do know how to teach along fundamental premises of money, okay, and finances. And I wouldn't be doing anybody any justice without talking about investing in the stock market as a whole without offering this little tidbit in that I think things are going to get very volatile over the next few years, okay? I could be wrong, all right? Now, the way that you want to prepare for that in being an ETF passive investor is, number one, stay the course, okay? Don't lose your mind when the stock market starts to get cranky and adjust back 20 bits on you. I want you to invest more, all right? By investing in those particular assets, you are in the driver's seat to add whatever little bit of pressure at the right time you want and take off pressure whenever you deem necessary, okay? So what I'd like you to do is identify in your budget how much you're comfortable with contributing, whether it be $100, $200, $300, or max fund that. If I hope those are in a self-directed Roth IRA account, all right? Continue to max fund, all right? Strategically buy the market as I described when the market takes a really, really big haircut, or the president sends out a tweet and the market tanks for whatever reason, or if we get a hiccup in any of these jobs numbers, or the earnings reports come out and they're not quite as favorable as they were at the beginning of the year when the tax cuts were announced, okay? I want you to use those as opportunities. I want to stay strong, stay steadfast in the market, because make no mistake, owning VOO and VO and VB, you own the stock market. And there's no better avenue to do that than those ETFs right there. You have to trust your program, trust the account, trust the expenses and the lack thereof. In each one of those accounts, you're paying 0.07, I believe, for mid and smalls, and 0.04 for the S&P 500. It doesn't get any better than that, all right? You really have to trust your program and trust your plan. Trust the diversity of those, okay? Invest when you have opportunity, save and build cash, which is what you should be doing right now with the market at an all-time high, and never, ever hesitate to draw back on your contributions if you need to. So if you're doing $400 a month and you feel like you need a little bit of extra spending cash, or you need a little bit extra in the budget to put to cash, then throttle it back to $200, right? So you're doing both, right? You're still being a passive investor. You are a stockholder. You own equities, and you're contributing on a dollar cost average program at a $200 clip, and you're taking that $200 and you're starting to build your cash reserve. Now, that cash recommendation is going to be very, very contrary to what a financial planner will tell you. Remember, because they're going to want it all. They could care less whether or not they take every dime from you and you don't even have clothes to wear. All right. As long as they have all the cash that you have to invest, they're happy. All right. They're not going to advocate as a young person that you keep cash on the side. I differ in that opinion because I don't have an objective to sell you a bunch of garbage that's going to cost you a bunch of money over time. Thank you for that question. Very, very good. I've got less right below. One negative is you cannot trade right now. If if I put something in today after the market has opened, then you have to wait until the next day. I've never had a problem with customer service. Yeah, Les, I thought the customer service was pretty good. I thought it was kind of quirky. The way that he fixed the mistake that I had build my portfolio the first time, and that he had to calculate through an Excel spreadsheet that he was doing kind of with a calculator to make sure things got washed out and reinvested the way I wanted it to. I thought that was kind of weird. But I thought the customer service was pretty good. At the end of the day, they fixed my problem, and that's all I really care about when I call customer service. I'm not a douche. I mean, I understand people are people. But I can tell you that the level of customer service and the professionalism is quite different when I call somewhere like Merrill Edge, okay, which is a fantastic, they're very, very good. And they're actually very supportive of their self-directed investors that are part of their community. All right. I've got Avi A on the line here, next in line. How do you feel the restructuring of the tech sector will affect the markets September 26th? I think people may shift in and out of sector ETFs as they follow favorite holdings. Yeah, probably. I think the shift is happening now. I think there's liquidation right now. A lot of the hedge funds are taking profits right now. That's where you're going to see some of the moves in some of the overlooked blue chip companies like a Pfizer, an AT&T. Comcast is starting to move. I think Kraft Heinz is going to start to move. Mondelez, Intel, Cisco, some of those names that I recommend, I don't make those lightly because I think there's some shift going from from the high growth to some of the value plays right now to continue to stay invested in the stock market, but also to take some profit off the table. Because I think a lot of these hedge funds have just been heavily weighted in Google, Facebook, and Amazon, and they're taking some profits right now. You saw that in the obvious price action last week. But I think the restructuring is going to be interesting. I think it's justified for sure. There's always going to be spider ETFs being bought for specifics. You guys know my position on that. I'd really rather see you buy the entire market instead of go with sector specific ETFs. The Vanguard's utility one has actually been very well to me. I may keep that because instead of owning one specific utility holding, I actually like owning that small piece of exposure in my portfolio to all of them to meet my recommended overall exposure of 3%. Okay, so I only have about $3,000 in that VPU, but I do like it. It's a good sector specific ETF. It's the only one that I own, but I don't make a habit out of buying and selling those. All right. I don't rebalance my M1. I just have a weekly allotment that's auto invest. I have that as well, Brent. I do. I'm not rebalancing at all. I made a video of a thing I didn't like, which was their distribution tracking on divs. Nice. Wow, thank you. I did not catch that video, and thank you for that offering. You guys are kind of learning me up a little bit on the platform. I will stay the course. I'm going to give it a fair shake. But just kind of getting used to some of the nuances of the program, and I'm used to going in and executing a trade, when I want, how I want, and it's a matter of seconds and it's done. And I've just kind of got to get used to having those higher growth names in the M1 account, owning them long term. Really, I think I'm done rebalancing as well. I'm going to stop doing that. I've only done it once. But I wasn't sure when it was going to go through, and I've gained clarity through the group tonight on that, so I thank you for that. Is the max contribution for both an orange and a Roth URI? Max contribution for both an orange Roth IRA. Yes, it is. I had to put both of those together. It is $5,500 for both, and that hasn't changed for years. It was $5,000 quite some many years ago, but it's been $5,500. It is $5,500 again for next year. So $11,000 if you are married and you have a spouse and you want to start that again. Those contributions can be made January 1 of the beginning of the year. Okay. So is the max contribution level 55 for both an IRA and a Roth IRA? It's one and the same. A Roth IRA and a traditional account. Those are your two different forms of individual retirements accounts, Roth and traditional. And they are both $5,500. Thank you for that question. That's very good. It's good to know that splits up into $458 per month on a max funding schedule. And that's why I recommend and throw out, look, if you can't do $458, which is a lot of money per month, I would earmark a starting amount of $25. Try to work yourself up to that 100. If you can do 100, great. Think about $100 as being almost 25% of your total overall $5,500 maximum cap. All right, so just think about it a little bit differently to get yourself to kind of justify, you know, getting started on a program and start that mental conditioning that I talk about all the time. Yes, they share the same limit. If you max one, you can't max the other. Thank you, Brent, for that. That is absolutely true. Most you can, oh, it jumped on me again. And this thing is amazing. It does this once per live feed. I've got to readjust here and recalibrate. Head up here and see if I can find my place again. Better play than Twitter. Oh, Weibo, K97's offering a pick there. Let's see here. Man, I've got a lot of questions coming into the group now. Damian, thank you. I appreciate that. Vote Damian Randolph, man. Thank you so much, man. We're evolving and we're building the channel. I'm growing and evolving with my community, getting more comfortable with offering the message. Had a lot of confidence in the message, but I'm certainly growing confidence in becoming a YouTube creator and offering, you know, delivering the content with some form of regularity. As I don't do this for a living. I do this channel for you guys, period. Okay. And if I would have known I would made this much after 2 years, I probably wouldn't have done it, because the financial compensation piece is absolutely something to where you better have a different motivation to do YouTube than financial. And I'm not talking about the guys that get on here and they start kicking butt right away. Okay, it's a hard line. If you think you're going to start a YouTube channel and just get rich overnight, it's not going to happen. It's very, very humbling. All right. So I've got a couple questions here. I've got Greenhorn Grill and Smoker. Awesome. My restaurant owner. I love it, man. You guys are in the group here. I really need to focus on getting through some of these because it's starting to stack up here. So I apologize for that. I'm a little behind. So I'm going to start to get through some of this. So finally, I've saved $2,000. I know it's a small amount after reading a few books and listen to this informed channel. I will wait for January to fund into my personal Roth account. You don't need to wait. You can do it now if you'd like. Greenhorn Grill and Smoker. You're going to be eligible for contributions for tax year 2020, actually in January 1. So don't confuse those two. You can make up contributions now for 2018 to 2019, but you're going to actually be eligible to contribute up to the tax deadline next year for 2018 as well. Okay, so there's a small overlap period there from January 1 to April 15th to where you can actually contribute for the previous year and the following year. Okay, so there's no reason to wait. If you were comfortable more with waiting and thought that the stock market was somehow gonna have a hiccup in January, at least get the account started and you can get them funded now. Okay, but don't wait and get that $2,000 into a self-directed account with Merrill Edge. Go ahead and do it right now. So yeah, I got some validation coming through with Pfizer and Cisco. These aren't secrets, guys. It's not a big deal. I'm recommending companies that everybody's heard of. But when I talk about makes chapstick, enough said. That's funny. Sorry. Why wait until January? There, Brent's picking it up. He's saying the same thing that I just kind of ran through a little bit. And I know that's not one of those things that you're throwing out there because you're procrastinating. I just think for whatever reason, you're probably giving yourself a little bit more time to save a little bit more investing capital. That's fine. But $2,000 is nothing to shake a stick at. I just said at the top of the video that I feel like $100 is a lot of money, and I still freaking feel that way. I wouldn't invest $100 in Tesla, let alone 10,000. You guys like those small pop shots I throw in there every now and then? Yeah, he deserves it. It's all right. He's tough. He'll survive. Maybe. We'll see. We'll see how he reacts on the next recession. We'll see what happens. I work for Mondelez. I think I knew that, actually. That's awesome, Doug. Thank you for offering that. I bet he's waiting for the crash since 2017. He's missed out on 20% returns. If you guys aren't paying attention to my boy Brent, financial investor, just offered up one of the smartest comments that I've seen this evening with regard to timing the market. It's impossible to do. You can't, so don't even try. And I sometimes, for entertainment, scour through some of the comments on the financial education channel, okay, which is not to be mistaken for the financial investor channel, but the financial education channel. I sometimes read through the comments, and it's amazing to me how that audience has got the pulse that it is so easy to time the market. And I'm here to tell you that that is complete and utter BS. It's complete and utter BS. You can't do it, so don't do it. If you want to participate and be a stock market investor, do it tomorrow. Do it tomorrow. Dollar cost average, save cash, get a budget. That's the only way to do it, man. Make strong moves in the market. Don't make weak moves in the market. Don't sit there and say that you're going to hold cash indefinitely and wait for some huge downturn. Because what's going to end up happening is the stock market's going to go down 20%, and you're going to invest all that capital, and it's going to continue down another 20%. That's what's going to happen. All right. Awesome, Brent. Thank you. Verizon, T-Mobile. I think T-Mobile is actually one of the best cell phone companies. I will say this. I've talked to a lot of customers of T-Mobile, and even though they have very colorful purple commercials and have an even more colorful CEO in Jeff Ledger, their service isn't quite that good. So you guys can beat me up on that if you'd like. T-Mobile is a beloved stock in the stock market. I've watched it do nothing but go up. I'm with Sprint, actually, and I think they're very, very good. And I've been a beneficiary of Sprint improving significantly over the years. I will not trade to T-Mobile. Did they just buy Sprint, I believe? Correct? Correct me if I'm wrong. T-Mobile just bought Sprint, or the other way around, something like that. But I do believe T-Mobile is a very, very good stock to own. I just questioned some of the reports I got with regard to the reliability. And as far as reliability, AT&T and Verizon are right there at the top. I do like Sprint. I travel abroad. I can speak on my Sprint phone free of charge. I have GPS, so I'm good to go there when I travel abroad. So whatever that means. Does it mean that you go out and buy Sprint at $10 a share? Hell no. I'd rather own T-Mobile. So very good offering there. So thank you for that. What about Groupon? Waiting for it to dip to a 52-week low to get it, as I think they may get bought out by Facebook or Alibaba. That's really interesting. I didn't know that, and Groupon is not one of those stocks that I cover. I should probably pay more attention. I spend the majority of my time covering blue chip stocks of bigger companies. I do like Groupon. I've used the service. I think it's great. But from a stock perspective, I cannot offer an opinion this evening. But that doesn't mean that I'm not going to go look at Groupon and do a little bit of research for you guys and have a little bit better opinion next time. But I hope that works. I would consider Groupon at its market cap being one of those offerings that I'd like to see you make in a portfolio where you've already got that working diversified base. And I'd like to see you with some cornerstone stocks inside the portfolio that are working for you before you enter into a little bit more of a risky proposition like a Groupon. But if it works for you, like I said, make it work, make it work for you. All right. If you end up getting into the position that takes a haircut at 10%, you've got to be willing to own that stock when it's downturned 10, 15% or so because of a piece of bad news. Okay. But I wish you all the well in that trade. I'm going to look more into it. Thank you. Pepsi instead of Coke. I do agree with that. I own them both. Pepsi has been on a tear. I just think they have a little bit more of an attractive portfolio of products. I've actually owned Pepsi for a long, long time. And just within the last 6 months, I've taken a nice position in Coke. I wanted a defense play, and I just thought in the low 40s, it was a great opportunity to pick up what I feel is one of the premier dividend players. Not really that excited about their valuation, to be honest with you, but I did go ahead and take a crack. I thought that the ratings were good, the value was good, And to get into a $100 billion company, I'm good with that. Just go ahead and get paid the dividend. Hopefully get a little bit of capital appreciation. I thought certainly it would flirt back with the $50 level again. And all the while I'm waiting, I'm getting paid the nice dividend in the name. And I know all these companies are really trying to move away from legacy products to new, more healthier options. But I do own both of those companies. Okay, so I do not mind recommending them to you guys. Verizon is the bomb. Yes, it is. I try to keep my curse. I wish I could come on here and curse up a storm. I have a mouth like a sailor, so I've got to curtail it, and I've got to offer a G rating on my YouTube channel, I think. I know a lot of people. I try to keep it toned down a little bit just in case there's anybody. I do have a little bit of responsibility to come on and offer. But anyway, yeah, no, I won't repeat what you said, but I do agree. It is the bomb. Thank you. Dude, Verizon is too damn high. Yeah, I don't think it's been in this $40 to $60 range for the last 10 years. So I don't know what you consider high and how relative you think. I have owned Verizon for over 5 years, and I've watched it go all the way down into the low 40s, and now here it is at $54. So it's been in a trading range of $15 for the last, ever since I've owned it. So I'm not really sure if you think $54 is high. I actually think it's trading around a 10 forward PE. So I'm not really sure what that means. But anyway, you're crazy. I don't know if I'm crazy. I could very well be. Verizon has a relatively low PE. Good. I've got Obstinate One. I agree. It's about 10 times. I think Comcast is trading just below 7 times. AT&T is trading just above 6. When you're talking about multiples, those are pretty recessed multiples. Now, keep in mind that the telecom sector typically trades at a pretty recessed valuation. All right. Yeah, I really wouldn't hesitate taking a small bite out of any of those companies right now, Verizon, Comcast, or AT&T. You just want to kind of keep the exposure down to a minimum, as the required allocation for that sector is around 3%. So what are we really talking about here, guys? You know what I mean? So keep it relative, you know. Let's talk about some of the fun stuff, man. Taking a position in Facebook, or even, do you take a bite out of Amazon right now? What do you think about what's happening with Google? Things like that. Those are the real questions, and that of which I do not have a right or wrong answer on. I do have an opinion about. I don't own Google right now. I did sell out of the position. I'm accumulating a small position in my M1 account, but that's nothing to kind of shake a stick at. Maybe $1,000 in Google. Which is about a half a share right here, 3/4 of a share, whatever that is, and a small piece in Amazon as well. So that's kind of what I think. Don't buy Verizon. More for me. Nice. I recommend Walmart, Procter & Gamble, J&J. I've got Larry Massa offering some comments with some blue chip cornerstone picks. I do want to offer my dividends, but I may have to wait until next week. But Procter & Gamble and J&J made that list. You're not a hedge fan. Okay, you guys are talking with each other. Financially, investor, you're right. You have an awesome channel too. I appreciate your M1 information. Thank you. I'm thinking of BTI, maybe 6 years. Awesome. Brent, I always thank you, man. You're killer when you come in here and help me with some of these comments. I really try to be as aggressive as I can. I've got Matthew Meyer on the line here. I'm 20. And 3 years into a whole life policy. It's a $100,000 policy paid up at 50 and has 900 annual premium. What are your thoughts? Stick with it or ditch for term? Whew, man. So it's a really good question. And to answer your question, I'm very, very careful about offering advice that is going to allow you to deep six a plan for whatever reason you purchased or a family member has purchased for you. Please correct me if I'm wrong. But I had my policy bought for me when I was 7 years old. There was more sentimental attachment to that policy than rational financial thought. Okay? So I hope you hear my advice. All right? What I ended up doing is getting rid of my whole life policy. I liquidated the entire thing. I took the cash value and I invested that money as appropriate. I'm not an idiot with money. I'm very smart. When I get small injections of cash, that money goes into the investment account. I'll give you guys another tidbit of my investing portfolio or my investing approach. For the last 12, 13 years, my income tax return has not been spent on anything. It's been saved or invested. Just a small tidbit of rolling that money slowly back in to benefit me. That's it. All right. But what I will tell you is when I did turn in my whole life policy, it was at about at $175,000, and I had the ability to have guaranteed step-ups. Okay, that'll be something that's familiar to you. But one thing that you're going to realize with whole life is it's very expensive. $900 on an annual premium, in my particular opinion, is expensive. That's about what I was paying as well. Around $73 a month, I guess, for around $185,000 in coverage. I will say that I did away with that. And the sheer reason why I did away with it was because I was able to supplement with a term life policy at about 1/3 the expense. Currently, I pay around $23 for $500,000 in coverage. And you think, okay, wow, it's term. Eventually, it'll go away. And the response that I have to that type of rationale behind the thinking is, what are you buying insurance for? All right. Who is going to benefit from you having that policy in place? All right. Does that policy cover the amount of time that you're looking to cover for your eventual beneficiaries? All right. And you have to think from the perspective that you're not here. All right. And if you're 20 years old, all right, I would much rather see you taking a staunch investment approach. All right. Now, I'm speaking to Matthew like you're sitting across the table from me now, because I know how important this message is for you to hear. First of all, stick with the channel. You don't understand how lucky you are to come across this information, because at about 7,000 subscribers, I'm very, very unknown on YouTube. Okay, very few people can find me. If you don't get it through referral, chances are you're probably not going to come across this message as young as you are. Okay, but having a whole life policy this young in your life, run the figures over the course of your life and then get back to me and tell me how much that whole life policy is going to cost you over the course of your life. The thing about it is, at 20 years old, I assume you're not married, okay? I assume once you do become married and maybe you have children, the assets are going to change in your life insofar as that $100,000 isn't going to satisfy the need if you're not around anymore and something happens to you and they're looking to cash in on that policy. $100,000 is not going to bridge the gap. And that's the question that I asked myself. If something happens to me, is the $185,000 going to be enough for my 3 dependents to live comfortably? I don't want them to have to worry about a thing, right, if something happens to me. And that's where the term policy met the mark, okay, at 1/3 of the premium, okay? So the basis of this explanation to you is use insurance for what it is meant to be used for. And it is in no way, shape, or form an investment vehicle. No way. It's part of an overall comprehensive financial plan. And I really want you to keep that in mind, okay? I know it was a longer-winded answer, but I wanted to give you the holistic answer so you didn't go out there and make a decision based on just what Ryan said, okay? I never, ever want somebody to do that. I always try to help you find those justifications and rationalizations for yourself to make a little bit more of an informed decision, all right? Matthew, I hope you heard me. Thank you for the question. Very sincere. I appreciate it. Whole life sucks. That's the roundabout way of saying basically it's expensive to pay whole life. The only real benefit, I guess, is that eventually somebody will realize that benefit. You know what I mean? If you do get married someday, right? Somebody, if something happens to you, somebody's going to get that money. The problem is if something happens to you when you're young, let's say 20, 30, or 40, it's nothing that a term life policy can't cover at a significantly higher amount for significantly less of a premium, okay? But that's obstinate one. Summed it up very nicely for me. Whole life sucks. Thank you, Obstinate One. I appreciate that. I'm going to have you on as a guest here, and we're going to run this together. I love it, man. It's great. Go with term. Larry, thank you. I appreciate that. That's in essence what I do now, and it makes more sense for me. Right, wrong, or indifferent, that's what we do. What do you feel about Micron? Geez, I liked Micron at 60. I like AMAT as well. Both of those stocks are trading. They're just getting the hell beat out of them. It's interesting. It's still the same company after we've run it through this meat grinder. Anybody who invested, they were talking about Micron going to $100. Every analyst was coming out of the woodworks and moved it significantly in the mid 50s up into the 60s, and now it's gone through the meat grinder, low 40s. It's a great candidate for a pickup on a short trade, but just be careful because chips are out of favor. The only chip maker I own right now, I do own Intel on the value side, and I own NVIDIA on the aggressive side. I do not own Micron. I do endorse the buy right here with a caveat to be careful, okay? But I think it's attractive right here in the low 40s, okay? Growth stocks are speculatives. Go with dividend value. There's a lot of validity to that statement, and that's why I really encourage folks, if they're looking to get into the stock market to start, I would compare Apple and Facebook, or an Apple and an Amazon. Really, Facebook at a 25 is actually maybe going through a transition from growth to growth in income or growth in value, okay? Because at 25 times, that's not a CRM Salesforce, which is an all growth cloud play right now. And it trades at about 185 times forward earnings. Okay. So when you start to get those stressed valuations, Alibaba's up over 50, 60, Google's at 40, 50, those are still some of the into the growth plays, right? But Facebook is really starting to transition back. And at 25, with accelerated earnings that they've had, unless they take a haircut on earnings, I think Facebook is actually a buy right here. But I'd rather see a beginning investor get involved with an Apple as opposed to any of the aforementioned Netflix, CRM Salesforce, Google, Amazon, any of those. I'd rather see you go with a Cisco, Apple, Intel, some of the hardcore established blue chip companies out there that have been around for a long time. Hell, I've owned IBM in my past. That's a huge dividend payer. I think it's a sleeper. I think one of these days it's going to wake up and people are going to be like, wow, how about Oracle? Nobody ever talks about Oracle. It's one of the premier cloud plays out there. And Oracle could have been on one of my best stocks under $50 list. As a matter of fact, I'll throw it out there right now. Oracle's a great cloud company. It's been around for a long time, very well established, a good company. So, pick your poison, certainly, but certainly I do offer for new investors, if you want to jump into the single stock arena, you really do have to have the fortitude and the risk tolerance for it, and test yourself. If you're young, you deserve to be tested, okay? The quicker you can get the tolerance to the stock market, the better. And if you've got to take a few haircuts over the course of a few years and take a few stocks into the downturn and learn that you can turn it from red to black, it just takes time. All that stuff has an inherent message to it. And I encourage you to seek out and do something a little bit more uncomfortable than just the status quo all the time, okay? You got to take some risk in life. The trick is to take a calculated risk and do it in the account that I recommend, okay? Because you're playing with such an open playing field, all right? Any risk that you take and hit a home run on, or you have a positive trade in, you get to keep it all, man. You don't get to share in any of that. You get to keep it all, and I want that for you, all right? Why would I put a cent in Alibaba when I can put money in Apple? Good point. And that's why my allocation in Apple is significantly more than it is in Alibaba. Right now, I've got less than very, very small percentage of my portfolio, probably less than 2% of my portfolio, probably less than 1% of my portfolio is in Alibaba right now, because I actually do feel like it's a good buying opportunity in Alibaba. I think next year, when it's back above 200, I'll remind you that you said that. Dividends are king. I agree. You need to do more. You guys are arguing with each other. That's awesome. What kind of research am I lacking? Not all stocks who gives dividends are good, especially who gives really high dividends. Yeah, so this might be a good segue to actually offer my dividends. And to that point, I've got Vian Xing on the line here. The highest dividend stock that I own right now is Blackstone Group. That does pay a higher than average dividend. It's actually a limited partnership, and I've been glad to own the partnership for a significant amount of time. It's made me in no small fashion a small fortune here over the last year, as it's finally kind of exploded. But I will offer my top 11 stock picks to you guys. Actually, I got my top 10 right now. And the highest payer is 6%. And you're going to find that there's a lot of stocks out there that pay a significantly higher dividend than 6%. And I think to Jian's point, you got to be kind of careful once you get above what I consider a healthy dividend. And that's between 2.5% and 3.5%. Some of the offerings in this list are going to give you a 6% dividend. One is going to give you 5%, a couple at 4%, 3 at 3%, and 3 at 2%. So kind of on an average, we're talking about in between, 3 and 5% on an average, it looks like. But the first one is AT&T, all right? And at $32 and trading it at a reduced forward PE at 6%, we're really good there. Number 2 is Royal Dutch Shell. Now, what didn't make my list is Exxon and Chevron, who can't get out of their own way. Royal Dutch Shell right now is a killer valuation. That's trading at around 10 times earnings, and that pays way over a 5%, almost a 6% dividend. I put these in order of the dividend from highest to lowest for you guys. Dominion Energy is next on the list at over 4% in Dominion Energy. Okay, so that's the one energy utility stock that I own outside of VPU, which is the utilities ETF through Vanguard. Okay, I do own Dominion Energy because it's just a fantastic company, pays a nice dividend. Next on my list, everybody's favorite, Verizon. Okay, it's been beat up tonight in the group. That's fine. All right, maybe a good entry right here from day one to get it in the mid 50s right here and start to enjoy some of that 4% dividend clip. Procter & Gamble, number 5. In the low 80s, I've seen it spike all the way up to 100 and roll all the way back to 60. It's right here at about $80. It's a good dividend, over 3% payer. We've already talked about Coca-Cola, ticker symbol KO at over 3%. We've already talked about Pfizer at over 3%. And then in between at about 2.5%, the rest of these, Johnson & Johnson, which is a key holding in my portfolio. I do own close to 3% of my portfolio, maybe in between 2 and 3% of my portfolio holdings is in Johnson & Johnson. I own around 44 shares of J&J right now, and it is contributing to itself, basically. Just a small money machine in and of itself with J&J. I needed to add a financial, and I believe the best bank right here to buy is Citigroup. Pays a 2.5 dividend. And to round out the list at number 10 is 3M Companies, which I am also proud to own. I only own 10 shares of 3M, but it's one of those cornerstones that you can buy and hold forever as they enjoy a huge suite in their portfolio of products that they offer. So that is my list right there of the top 10 dividend stocks that I'll offer through this for you guys who have stuck with this live message for an hour and 42 minutes. I will start to wrap it up, guys. I am starting to lose my voice. I think I've more than made up for my technical deficiency last night. I do want to thank everybody who's joined the group tonight. I'm going to try to scroll through here and try to look for some of these questions that I can get to as we kind of start to round down this particular live stream on a Saturday. I want to thank you guys. This is awesome. This has been a killer live feed for me. I just want to thank you guys for all the help and support. I'm just kind of scrolling through here. Jeremy's an idiot. Don't listen to that guy. I don't listen to anybody, to be honest with you. I always try to profess along the lines of trusting yourself. And I try to give you the tools to do just that. You want to challenge somebody, challenge me as well. And then you're getting the intent of the message. No doubt about it. All right. The difference is I don't charge you a dime for the knowledge. Okay. So I've had a few people come on and beat me up, but that's fine. But at the end of the day, I offer this to you guys, free of charge. All you're really doing is paying me in time. And quite frankly, you can turn it off at any time. But there's a lot of value here that you're getting for free, no doubt. Access to the Facebook group, all that stuff. I've got guys that are really, really approaching me about coming out with a stock market course of some sort. And my honest opinion about that is when the timing is right on offering a stock market course, I may end up doing that. But it's going to be my way, and it's going to be the right way. And I'm not going to turn it out just for the sheer intent of making money, because that is going to detract from the very essence of why I'm doing this channel. And that's to empower individuals. All right. And I've said it many, many times. I don't need your money. You do. All right. It's that simple. Just like other people don't need mine. All right. So I'm going to try to get to the end of this here. I set up my 401k when I started the job 10 years ago. I didn't even know what it was, but I'm happy now looking at it with the same money that it has built. And exactly. I've got John here who's hit me up with a very sincere question. And that's exactly what you need to enjoy about a 401k. It's one of those autopilot programs that you can basically set it in motion. And like you admitted, you really didn't understand why you did it, but now you're happy that you did. Don't stop there. Don't get complacent. All right. Always try to challenge the amount that you contribute to it, and also entertain the opportunity of listening to my message and what I'm talking about in growing those additional retirement accounts. You've got your 401k, but I wouldn't stop there. I would start a self-directed Roth. And if you're married, John, or if you're single, right, I would take advantage of that. And because you have that 401k diversified base already working for you, use this as an opportunity to kind of springboard yourself into a self-directed Roth IRA account, and maybe set yourself up with a nice portfolio of single stock. And I can help you do that. That's very simple to do. It just takes a little initiative on your side to say, gosh, Ryan talked about, he said I'm doing a good job, in my 401k, and you are. But I don't ever want you to get complacent on your savings, okay? Because you've set this thing on a course, and you've provided yourself some validation as to why you, in retrospect, look back on the decision that you made to start that 401k. Now imagine where you're going to be 20, 30, even maybe 40 years down the line, looking back over the totality. Are you going to look back and say, gosh, Ryan told me I needed to maybe look at doing more, and I chose not to do more, right? Are you willing to rest solely on the program that you've got going with your 401k, or do you want more? Okay. And I would highly encourage you to seek out more, because there's more there to be had for you, John. But thank you for that question. That's really awesome. I'm glad I got to it. I think that the financial services are the ones that gain most in the forms of management fees. I've got Cal Bouzaid. I hope I didn't butcher that last name, but Cal hit me up with one of the questions, that of which I explained through the compounding calculator, and my comparison that I do between a Roth IRA in a self-directed account and a Roth IRA in a managed account over the course of 40 years. All right, 40 years. The managed account over the course of 40 years at a 3% clip of fees is going to render the investor who holds that account only 40% of the total overall potential returns. 60% will be lost to the financial planners. That is a fact. That's not my opinion. That's just the math of it. All right. So you are more right than you know, Cal. Thank you for that, sir. That's very awesome. Thank you for allowing me to re-emphasize one of my favorite points that I make on this channel, is that the majority of that loss is to the financial institutions. And that is a fact. All right. Very cool. I'm going to try to get to the end of this if I can. I'm trying to cherry pick some of these questions out of here that I've identified as really needing my attention. I have almost 8 years in service, but I've applied for the blended retirement. Awesome. Call me crazy, but I take it more safe than legacy retirement. It is. It guarantees you the transferability going with the blended retirement system. So I'm really glad that you brought that up. Certainly a topic for a different day. I didn't have that option. I missed out on eligibility by a few months, actually. But I would have kept the legacy. I'm 13 years in now. I've got 7 years left, so I'm kind of riding on a plane a little bit. But come or hell or high water, I'm making it to 20, maybe even 25 or 30 if I can. But we'll see. We'll cross that bridge when we get there. But not sure what a BRS is. It's the blended retirement system. I got out in 2013. I only have a TSP. So Brent, the blended retirement is new actually in the military. So they basically set it up more of like a traditional program. The Roth option is not available through the BRS. It is available insofar as you can still contribute to the Roth, but they're not going to match you. The BRS is a little bit more set up to allow the government to take their money from military members later on down the line. And there's a transferability piece that's very attractive to anybody that's new getting into the military on that deal. And they've got all the information on the TSP website through YouTube. If you're interested, kick over there, watch it. As a prior serviceman, you could probably gain some value, or if you get questions through your channel on it, it's good to know what they've got to offer. I wouldn't have opted into it. I actually stayed the course with my legacy program. I wasn't eligible anyway, but I wouldn't have opted in just because of my own personal decision of a lot of the investments I make on my own as well. But it's the blended retirement system. So come to New Zealand. I'll buy you a beer. Now, okay, so Cal mentions New Zealand here. And New Zealand just so happens to be #1 on my list. #1 on my bucket list. It is #1. There is no place that's greater than New Zealand on my list. I had the distinct pleasure of doing some commercial fishing out of Los Angeles with a gentleman from New Zealand, and he was the nicest individual I've ever met in my life. One of the nicest people I've ever met. They were trying to start the squid fishery down there in New Zealand, of all things. And he was the coolest guy. And he said, Ryan, you got to go. You just got to go. You're a free spirit. You'll love it. And I will make my way down there someday. So I may actually cash in on that. All right. So don't make an offer that you can't come through with. And that's really, really cool. I really appreciate that, Cal. So I hope you appreciated the information that I kicked back to you as well. I'm going to, Ryan is taking the world by storm. Not yet. I hope to. We're gonna try, man. We're gonna try. We're definitely putting ripples out there. The financial institutions don't want guys like me, but you got to understand, we're a small fish in a very, very big pond of ripping people off. And I don't mind telling people how it is, because that's how it is. It really is. I have financial planners all the time, man, that want nothing more than for guys like me to go away at the expense of thousands and thousands of people, man, thousands of people. But for them to make their money, they have to deploy trickery, and they have to deploy and take advantage of the naive perspective of new investors. And it's not their freaking fault. That's the problem. It's not a new investor's fault when they approach a financial planner with all sincerity and they ask for help and they don't get help that has their best interest in mind. And that in lies why I came out with the channel in the first place, to spread a message, to let people know that they can become a participant in the stock market by themselves. It's that simple. What's safe stock like? Okay, I'm getting to the end of this, guys, and I am going to wrap it up here. Hopefully I can wrap it up below 2 hours, but I want to get to every freaking question, that of which, because I owe you from last night. The technical difficulty was something that it irritated me. We've got that fixed. I can promise you and assure you that barring any major crazy problems, we shouldn't have that problem again. So we will continue to offer the live feeds on Friday evenings. So tune in again next Friday. If the storm ends up being something problematic and I am unable to do the live feed, then I will premise this right now. That is what I will be mixed up with. All right. So if you do not see a live feed next Friday, make no mistake, I am indisposed trying to help people get their lives put back together. All right. And that is a fact. So you guys are going to have to give me a rain check next Friday, which I do feel like is going to probably be a squirrely one. The tracks are not looking good. So I will leave you guys this evening. Does anybody think investing their entire portfolio in onion rings is a bad idea? That is awesome. That's pretty funny. Thank you, Ryan. I do enjoy all of your videos. Gene, thank you. And thank you for you. I've got Mr. Les Gibson on the back here. Thank you for your undying support of the channel. I really appreciate it. For those who have not, please hit the like button on the way out. It helps the channel. I believe that it does. Any support that you can render to the channel, I highly encourage you guys, share the message with friends, family out there, man. Turn them onto the channel. If they don't want to come on and they don't want to watch a YouTube, have them send me a direct link. I'm pretty good with responding. I do the very best I can. It does consume a lot of my time. And again, I don't take any compensation at all for that. So please bear with me if I don't get back to you within the first day or so. I do my best to reply to that. But absolutely hit the like button. Thank you for all your support on this live feed this evening. I really appreciate your guys' interaction with the channel. And I will catch you guys hopefully next week. If not, it will be the following week, or maybe we'll throw down on a Saturday. But catch me over into the Facebook group as well if you guys want to continue some of the conversations. Thank you so much for joining me on a Saturday, guys. Be well and enjoy the rest of your weekend, guys. Thank you so much.